73% of mutual fund investors quit within 2 years. I have never been a serious mutual fund investor, and here is why. According to SEBI data, the average mutual fund holding period is just 2.5 years. That's not investing, that is gambling with your future. While everyone is obsessing over 2000 rupees SIPs, I built a system that delivered 40 times returns in 6 years. Today, I'm exposing why mutual funds keep you poor and revealing what rich people actually do instead. Most people think mutual funds are the safe, disciplined way to build wealth. That is the biggest lie in personal finance. What mutual funds actually do is create an illusion of you being disciplined while keeping you poor for decades. I'm going to prove this with data that fund houses don't want you to see. You will discover the diversification debt trap, the shocking truth about fund manager incentives, and the two paths rich people actually take to build transformational wealth. Here is the government data that will destroy everything you believe about mutual fund investing. There is this massive sales army of banks, advisors, and relationship managers who make money every time you churn your investments. They want you to keep moving your money around. Last month, a friend told me his bank called him 6 times to switch funds. 6 times. Each switch generated commissions for them while destroying his returns. According to official SEBI data, 50% of mutual funds units are redeemed within 1 year, 73% within 2 years. Average holding period, just 2.5 years. That's not investing, that's financial suicide. You need decades for compounding to work, not 2.5 years. The real money in investing is in the sitting, but this data proves most investors are not willing to sit. And that is exactly what is keeping them poor. But even if you could hold for decades, there's a structural problem that makes mutual funds wealth killers. We'll come to that in just a minute. But first, let me give you a reality check on people who got rich from mutual fund as per social media. Everyone is sharing videos and talks of Gajendra Kothari's 35 lakh rupees monthly SIPs. But they're missing the most important part of his story. His income from his business, which is helping people invest in mutual funds, is far higher than that SIP amount. This changes everything. Mutual funds have little role to play in his wealth equation. Even if he put that money in fixed deposits, his wealth wouldn't change much. The SIPs aren't making him rich, the business is. He has positioned himself to benefit from other people's investments. Don't benchmark yourself against people making crores from their businesses. That is not mutual fund success. That is business success disguised as investment advice. So, what is the real structural problem with mutual funds that keeps regular investors poor? The biggest problem with mutual funds isn't corruption or fees. It is something fund managers think is their strength. Fund managers aren't evil, they're just trying to save their jobs. I once met a fund manager who told me I can't afford to underperform the index by more than 2%. If I do, I'm fired. That's when I realized the game was rigged against investors. Fund managers keep 30 plus stocks knowing that diversification benefits stop after 15 stocks. This approach might work for someone near retirement, but it is financial suicide for young investors. If you want to get married, study abroad, or retire early, you need higher returns. But fund managers are playing to not lose, not to win. 65% of India is under 35. Yet, mutual funds serve the mediocre returns designed for retirees. That is a massive disservice to the majority. But there is an even more insidious trap that most investors fall into. If you are doing 2000 rupees SIP and feeling good about yourself, I need to tell you something harsh. Most mutual fund investors are hobby investors. They start small SIPs and feel disciplined. But when their income increases, they spend that extra money instead of stepping up investments. I was one of them. I started with a 1000 rupee SIP thinking I was being smart. My income increased and I never stepped it up. I closed it after 3 years, cashing some 41,000 rupees. That is not even half of my monthly income then. I was not acting smart with investments, but was actually being poor. If you have a few thousands to invest and want your money to work as hard as you do, then first increase the size of your investments. And second, choose your investment vehicle well. Mutual funds are the wrong vehicle. If you already have crores, mutual funds versus FDs doesn't matter. But if you have a few thousand or lakhs and want transformational wealth, you are in the wrong game. The hobby investor mindsets keep you comfortable but never wealthy. And comfortable is the enemy of transformational. And then there is the outright scam that traps even experienced investors. Thematic funds are legalized theft. Here is how they rob you blind. Fund houses launch thematic funds at the peak of the trend when the hype is maximum. In the 2000s, many fund houses launched PSU and infra funds. The long term growth in the funds that survived would be less than 10%. Even the best of these thematic funds that exist today have a tough time outperforming the Nifty 50. That is hundreds of crores of fees money burned to achieve index return. But yet, 2024 was one of the best years for thematic mutual funds. So, why, despite historical evidence, these funds attract so much money? The answer is simple. It's an easy sell when everyone is talking about a theme. We get carried away, but that backfires because markets don't favor any theme for long, especially in our age of rapid information transfer. These funds consistently underperform in the long run because they are designed to extract fees from new funds, not generate returns. Thematic funds are the marketing gimmicks that prey on FOMO. Don't be the sucker who falls for them. But even if you avoid all of these traps, there is a fundamental reason mutual fund can never create transformational wealth. Here is why. Most investors enter with an illusion of discipline but with no end goal. They invest in multiple schemes, have no exit strategy, and panic at the first market dip. If you earn 10 lakhs or less and spread yourself thin with expenses, you are already fighting an uphill battle. Even high earners with expense heavy lifestyles struggle. When your income statement is tilted towards expenses, you are setting yourself up for a tough ride. The best mutual funds can give you is comfortable wealth, enough to survive without income if you live frugally. That's not bad, but it's not transformational. But what if you want more? What if you want generational wealth? What if you want to break the cycle? Then you have exactly two choices, and most people don't even think about them in a logical manner. Here are the only two paths to transformational wealth that actually work. Everything else is just noise. Remember Gajendra Kothari? His wealth comes from his business, not his SIPs. He positioned himself to benefit from other people's investment. That is his success vehicle, not mutual funds. But entrepreneurship has a 95% failure rate. You lose money, time, and sanity. If you have family responsibilities that require steady income, this isn't a viable option. I actually went this route. I still remember those panic attacks at the thought of running out of money and not being able to pay the rent. I saw my savings diminish slowly with no tangible success in business. It was tough and did not last long. Not because I succeeded, but because I ultimately took another job. The second path is to become a direct stock investor, not a mutual fund investor, a stock investor. Before you say that is not for me, hear me out. This doesn't mean burying yourself in financial data. You start small, so even if you lose half of your capital, it's small money. But what is the upside? Transformational wealth while you live your life normally. Your money works as hard as you do. That is the difference between being comfortable and being wealthy. Let me show you exactly why direct stock investing is so powerful. Direct stock investing lets you be an entrepreneur without the entrepreneurship risk. You back multiple able entrepreneurs instead of being one yourself. You can back 10, 20, or 30 businesses. If you start your own business, you are stuck with one. Here, you have flexibility. One of my friends started with 5 lakh rupees 3 years ago. He backed 8 small companies, 5 did okay, 2 failed completely, but one went up 30 times. That one winner made him more money than 20 years of mutual fund SIPs would have. His 60,000 rupees investment in one company fetched him 19 lakh rupees. But not all of those bets work, and the ones that don't, you exit and move to the next. A fraction of those bets will anyway contribute to most of your wealth. That's how all good investing systems work. Therefore, with a good investing system, you can be in the top 0.1% of richest investors without the undue risk. Several small cap investors have made it there, many from non finance backgrounds. It just takes honest effort to crack the code. I know you don't want to give up leisure time, but the returns on time invested here compound faster than anything else you'll ever do. And I have proof this works. I have a system that delivered 40 times returns in 6 years. Let me prove it and tell you why I'm sharing this for free. This took years to build and perfect, but once built, it changed everything about my wealth trajectory. Why am I sharing it for free? Because I know what it is like to have nothing. I come from a time when resources weren't just scarce, they did not exist. I almost dropped out of school to work odd jobs in a nearby shop. I hate when friends passed by because I was embarrassed by my financial state. I had to skip things other kids called basic necessities. It's a miserable way to live. I know many of you feel that inferiority complex because of money. I'm trying to pull as many people as possible out of that state. If you need help starting your small cap journey, comment small cap below. I will personally guide you. No charge. But this is only for people willing to go that extra mile. If you want to stay in financial misery thinking you don't have a chance, this isn't for you. So there you have it. Mutual funds keep you poor through diversification trap, sales machinery that destroys holding periods, and the hobby investor mindset that prevents real wealth accumulation. For transformational wealth, you have two choices: build a business or become a direct stock investor. Small cap investing gives you the entrepreneurial upside without entrepreneurial risk. I escaped the rat race using a system that works extraordinarily well and takes a fraction of your time. Now it's decision time. Will you continue the illusion of discipline with 2000 rupees SIPs that keeps you comfortable but never wealthy? Or you will take control and build real transformational wealth? In my next video, I'll reveal the stock basics you need to know to make transformational wealth from small cap stocks. You won't want to miss that. Your financial freedom is in your hands, not in the hands of fund managers who care more about job security than your wealth. If you are ready to learn the system that delivered 40 times returns in 6 years, comment small cap below right now. I personally read every comment and will guide you on getting started. If this video shattered your illusions about mutual funds, smash that like button. It helps other people discover this truth too. Subscribe for more content that challenges conventional financial wisdom and reveals what rich people actually do with their money. Thank you for watching and stay sharp.